Hey there, and welcome to today's Explainer. We are taking on a topic that sits right at the absolute center of our modern financial lives. Yet for so many of us, it remains almost entirely misunderstood. We're talking about credit. A positive credit record does a whole lot more than just let you borrow money. It actually lowers your borrowing costs, reduces deposits for things like utilities and cell phones, and it can even remove barriers to housing and employment. So today, we are decoding the hidden math that controls all of it. We are going to demystify the credit algorithm. So what exactly makes up your credit score? It's kind of the million-dollar question, right? A lot of people treat their credit score like this mysterious black box, like it's a magical number that lenders just pull out of thin air. But the reality is actually far more logical. Credit scoring is a highly systematic methodology. Think of it as a very precise mathematical recipe that evaluates your behavior over a timeline. It's looking at your account activity, your relationship depth, and your payment history to accurately assess risk. Okay, let's dive into this. Here is the absolute core of today's explainer. Your credit score is determined by 5 specific categories, and here's the kicker, they are not weighed equally. Payment history makes up this massive 35% slice. Amounts owed, which is also known as credit utilization, comes in right behind it at 30%. Then we have length of credit history at 15%, followed by your credit mix at 10%, and finally, recent applications for new credit making up the final 10%. Over the next few minutes, we're going to break down exactly how you can optimize every single one of these slices. Here's our roadmap for today. First, decoding the algorithm. Second, payment history. Third, credit utilization. Fourth, history and mix. Fifth, managing new credit. And finally, putting together your credit action plan.
Section 1. Decoding the credit algorithm.
Now, this represents our ultimate goal, a healthy, high credit score. Whether you're aiming to buy a house, rent a better apartment, or honestly just lower your car insurance rates, your everyday actions dictate exactly where that needle points. It's literally just a matter of learning how to feed the right data into the algorithm. Because every single financial move you make, well, it either pushes your score up or it pulls it down. The algorithm weighs these movements purely based on risk. For instance, making your payments on time every single month consistently pushes that needle up. On the flip side, opening way too many accounts all at once, that signals increased financial stress and risk, which drags your creditworthiness down. Section 2, your payment history, which is the single biggest factor. Now, what's really interesting about this is the sheer difference in momentum between building credit and losing it. Building a very good credit score, we're talking 700 or more, typically takes up to 7 years of consistent, reliable behavior. But look at the immediate damage that can happen. In one documented example, a person with great credit paid 2 bills just a few days late. Her credit score absolutely plummeted by an average of 60 points, and it took 2 grueling years just to recover. This massive penalty is exactly why payment history commands 35% of the algorithmic pie. The system really doesn't care if you pay before late fee hits. If you miss the officially defined payment date, the algorithm penalizes you heavily. Section 3, credit utilization, 30% of your score. Utilization is simply a measure of how much of your available credit you are actively using. And listen, if you remember only one number from this entire explainer about revolving credit, please make it this one. 30%. Experts universally recommend keeping your utilization ratio below this number to avoid a rapid and honestly pretty substantial decrease in your credit scores. Let's actually see how this plays out with some real-world math. To figure out your utilization, you take the balance you owe and divide it by your total credit limit. So if you have a balance of $1,250 on a credit card that has a $5,000 limit, you divide $1,250 by 5,000, multiply that by 100, and boom, you get a 25% utilization ratio. Because 25% is under that 30% threshold we just talked about, the algorithm views you as a responsible borrower who isn't maxing out their financial lifelines. But hey, if you want to climb to the very top of the credit mountain, 30% is really just the baseline. The secret to achieving the absolute highest possible FICO scores is aggressively keeping your utilization under 10%. And a quick note here, paying off your balance in full each month doesn't necessarily hide your utilization if your balance is reported to the bureaus right before you pay it off. So keeping that running balance low is absolutely key. Section 4, history and mix matter. First up here, let's talk about credit age, which is 15% of your score. Basically, the longer your accounts have been open, the better. You should actually keep your very first credit card open, even if it has a terrible interest rate, and you literally just leave it sitting in a drawer for sentimental reasons. Maintaining a perfect payment history on that old aging account continually feeds positive data to the algorithm over time. Second, your credit mix makes sub 10%. The algorithm really likes to see that you can juggle different types of debt responsibly, balancing revolving credit, like your credit cards, with installment loans, which are loans where you pay a fixed amount regularly, like a car loan, proves you can handle a diverse array of financial responsibilities.
Section 5, 10%. Managing new credit.
So the crucial point here is that you've got to limit your applications for new credit to no more than 2 every 6 months. I know, it's incredibly tempting to sign up for multiple store credit cards during the holidays just to snag a 15% discount at the register. But piling on multiple new credit accounts in a short period, that signals to the algorithm that you might be strapped for cash, making you look like a much higher risk.
To manage this without stressing out, you need to understand the difference between inquiries. When you formally apply for a loan or a credit card, a lender performs a hard inquiry, pulling your official history. This does cause a short-term ding to your score. However, checking your own credit on a monitoring site is a soft inquiry, and it absolutely does not count against you. Oh, and a quick pro tip. If you're rate shopping for mortgage or a car loan, the algorithm is actually smart enough to group multiple inquiries made within a roughly 14 to 45-day window into a single event. So really, don't be afraid to shop around for the best rate.
Section 6. Your Credit Action Plan.
Look, if you run into trouble, there are no magic shortcuts. The absolute only way to repair and maintain a great credit profile is to follow these 3 steps. Step 1, pay your bills on time every single time. Make it an automatic habit by setting up autopay directly from your checking account. Step 2, aggressively pay down your debt over time to drive that utilization ratio below 30%, and ideally below 10%. And step 3, limit applying for new credit. Only ask for new lines of credit when you genuinely need them. And this brilliantly illustrates the journey. Reaching the peak of good credit takes consistency and time. It can take up to 7 years to reach that summit. But the blueprint to get there? Well, it's no longer a secret. You now know exactly how much weight the algorithm gives to your payment history, your balances, and your new applications. So, I want to leave you with a final question today. Are you ready to make your credit score actually work for you? You've got the mathematical recipe. You know the exact rules the system operates by. Now it's time to take control, optimize those financial habits, and start pointing your own credit gauge up. Thanks so much for joining us to decode this vital topic, and we'll see you next time.